Across the United States, a quiet economic storm is spreading street by street. Behind for sale signs and locked doors lies the story of families losing homes once thought secure. Mass layoffs, soaring insurance costs, and stagnant wages are merging into what analysts call a slow-motion foreclosure wave. By the end of this video, you'll understand how it began, where it's spreading, and why it could permanently redraw who owns America. Subscribe to Global Lens for deeper looks at the forces reshaping economies worldwide. Chapter 1. The Foreclosure Surge Few Want to See. According to Adam's third quarter 2025 foreclosure market report, about 101,500 U.S. properties received foreclosure filings, up 17% from a year earlier and the highest quarterly total since 2015. Nationwide, that's roughly 1 in every 1,400 housing units. Florida recorded the worst rate, with 1 in 814 homes in foreclosure, followed by Nevada, South Carolina, Delaware, and Indiana. Unlike 2008, today's stress isn't reckless lending, but a slow affordability squeeze. Mortgage delinquency rates remain near record lows only because lenders extend grace periods or modify loans. Behind those numbers, ownership costs, taxes, insurance, utilities, and maintenance have jumped about 40% since 2021. Millions remain current on paper, yet financially trapped. Chapter 2. Florida, America's pressure valve. Florida's housing boom has become its biggest liability. Average homeowner insurance premiums now hover around $8,800 per year, nearly 4 times the national average of just over $2,000. Since 2020, they've risen more than 25% annually. 7 major insurers have withdrawn, forcing residents onto the state-backed Citizens Plan or to self-insure, while property taxes have climbed 30 to 50% since 2019. After the 2021 Surfside condo collapse, new safety laws required costly structural repairs, often tens of thousands to over $100,000 per unit, some cases near $200,000. For middle-income owners, even those with 3% mortgages, the math no longer works. In Orlando, Jacksonville, and Miami, roughly 1 in 230 to 250 homes is in foreclosure. A state once powered by migration and vacation demand now stands as a warning sign for the nation. Chapter 3. The Contagion beyond Florida. The same pattern is spreading across the country. Nevada, Delaware, and Alaska have all seen double-digit increases in foreclosure activity this year. In Nevada, housing listings have climbed by nearly 30%, while hospitality revenues have declined for 3 consecutive quarters, pushing household debt ratios back to pre-2008 levels. In Delaware, foreclosure initiations have reached their highest point since 2013 as property taxes and insurance costs continue to rise. And in Alaska, delinquencies have surged almost 40% in just 6 months amid falling oil revenues and rising transport costs. New hotspots are emerging in Texas, California, and Illinois. Texas foreclosure starts rose 22% in 2025, led by Travis and Harris counties where reassessed property values sent tax bills soaring. California's filings increased 14%, centered in wildfire risk zones where insurance premiums have skyrocketed. Illinois' Cook County recorded its largest foreclosure pipeline since 2018 as wages stagnated and taxes rose. Across these regions, the pattern is identical. Costs keep climbing, incomes stand still, and household savings are nearly gone. Chapter 4. The Layoff Wave Feeding the Crisis. White-collar layoffs are erasing the financial stability once considered untouchable. Since January 2025, tech and manufacturing companies have cut more than 150,000 jobs. Microsoft announced about 6,000 cuts in May and another 9,000 later in the year, while Meta eliminated roughly 3,600 positions, about 5% of its workforce. Intel, Amazon, and numerous startups have followed. High-income borrowers now lead delinquency growth. Defaults among households earning over $150,000 a year are up around 40%. In California's Santa Clara County, more than 9,000 borrowers entered default notices, the highest since 2011. Many relied on stock-based pay, and as the Nasdaq fell about 19% this year, their equity cushion evaporated. Fixed expenses such as mortgages, car leases, tuition, and insurance now consume 2/3 of income. Once those paychecks stop, reserves run out within months. Leverage, not bad lending, has become the new fault line. Chapter 5. The Debt Trap. Total household debt has hit a record $18 trillion, with mortgages accounting for $12.4 trillion and credit card balances exceeding $1.25 trillion. About 7% of those balances are now 90 days past due, the highest rate since 2008. At an average 22% APR, Americans are paying roughly $280 billion a year in interest alone. Headline inflation sits around 2.8%, but essential costs are rising much faster. Electricity is up 9%, auto insurance 16%, and property taxes about 20% in many metros. Wages have grown only 3%, leaving real incomes negative. The median existing home price in August 2025 was roughly $423,000. At 6.5% interest with 10% down, a typical payment is around $2,300 per month, requiring an income near $95,000 versus a national median of $79,000. First-time buyer participation has fallen to its lowest level since 1981. The average household now spends nearly 45 cents of every dollar servicing debt. Chapter 6. Credit tightening and the feedback loop. Even as overall mortgage delinquency rates dipped slightly in mid-2025, foreclosure starts rose 22% year over year. Each case removes collateral from circulation and further tightens credit. Listings climbed to about 1.3 million, up 19% from last year, while pending sales fell 14%. Nearly 38% of homes on the market required price cuts, the highest share since 2012. The Atlanta Fed reports that mortgage and auto loan rejection rates are at multi-year highs. For middle-income borrowers, credit access is vanishing, creating a self-reinforcing cycle of reduced lending, weaker demand, and rising distress. Chapter 7. The Rise of Institutional Landlords. About one-third of single-family homes sold in 2025 went to investors, and nearly 30% were all-cash purchases. Private equity funds, real estate investment trusts, and large corporate buyers are snapping up discounted properties and turning them into rentals. The national homeownership rate remains around 65%, but ownership is concentrating among fewer hands. Median rent for converted foreclosures is about $2,100 per month, 14% higher than a year ago. In Metro Atlanta and across parts of Texas and Florida, 1 in 5 sales now involves an institutional buyer. Entire neighborhoods are slowly transforming from owner-occupied communities into corporate assets. Chapter 8. A structural imbalance, not a bubble. The 2008 crash was driven by bad loans. The 2025 crisis is driven by math that no longer works. Subprime adjustable mortgages make up less than 3% of the market, yet ownership costs are rising 5 times faster than income. Every 1% drop in home values erases roughly $280 billion in collateral value, undermining pension funds and mortgage-backed securities. Recent Fed rate cuts from 4.25 to 4.0% barely moved mortgage rates, which hover around 6 to 6.7% because capital remains locked in high-yield bonds. Inflation still erodes real pay. The market appears stable but is quietly decaying underneath. Chapter 9. Political and social consequences. The top 10% of households now hold about 45% of all residential real estate value. As ownership concentrates, property tax bases shrink and local services erode. Banks delay foreclosures to avoid recognizing losses, masking the true extent of distress. Analysts estimate more than $100 billion in pre-foreclosure debt could hit the market in 2026. If released simultaneously, values could fall 10 to 15% and erase trillions in equity. State legislatures are debating insurance reform and temporary foreclosure stays, but none can offset the basic reality that costs are outpacing income. Chapter 10. The Slow Motion Crisis. This is a long erosion, not a crash. Household savings are at their lowest since 2013 while revolving credit reaches record highs. Government aid funds for homeowners are nearly exhausted. Every new shock, from layoffs to insurance failures to credit tightening, pushes the system closer to its limit. Transactions slow, inventory accumulates, and equity melts away. On paper, the market looks balanced, but in practice, it operates at half speed, a quiet contraction disguised as stability. Chapter 11. The Middle Class Under Pressure. Home ownership has anchored the American middle class for decades, but that anchor is slipping. More families are transitioning from owners to renters as housing devours take-home pay. Even those with 3% mortgages feel the squeeze as taxes and insurance jump. With refinancing blocked and savings drained, financial resilience is eroding. A New York Fed survey shows that 38% of adults have no emergency savings, and real median wages remain near 2019 levels. Middle-income households are relying on credit cards to cover necessities. If white-collar layoffs spread into service sectors in 2026, a second wave of defaults could follow, reducing spending, demand, and home values further. Chapter 12. Looking ahead to the reset. Most economists expect a slow reset rather than a sharp collapse. Home prices may decline moderately, but equity losses will be severe. Institutional investors will keep accumulating properties while traditional buyers face barriers. Real wage growth, insurance reform, and local tax relief are the three conditions for stability. Without them, the market will remain stuck in stagnation, neither boom nor bust, defined by low mobility and aging housing stock. Chapter 13. The renter's ripple effect. Foreclosures don't just hit homeowners, they reshape the rental landscape. As displaced families seek apartments, demand outstrips supply. The median U.S. rent in September 2025 stood around $2,050, up 6% from a year earlier. Cities like Tampa, Dallas, and Phoenix saw double-digit rent spikes as former owners became tenants. This migration pushes households into smaller markets such as Boise, Knoxville, and San Antonio, where rents are lower but local wages can't keep up. Economists call it the housing ripple effect. Foreclosures in one region inflate rents in another. The Dallas Fed notes that more than half of Texas renters now spend over 30% of their income on housing, the heaviest burden in 2 decades. Even Americans untouched by mortgages feel the impact through rising rents and shrinking mobility. The United States isn't alone. In Canada, variable rate mortgages have driven average payments up 35% since 2021. And foreclosure filings in Ontario are at a 10-year high. Across Europe, similar signs are emerging. The United Kingdom reports a 20% rise in repossession claims, and Germany faces insurance premium inflation linked to energy costs. Investment funds and real estate investment trusts are consolidating housing stock worldwide, transforming homes into financial instruments rather than shelter. The same pattern, high debt, slow income growth, and concentrated ownership, has become global. America's foreclosure wave is merely the most visible chapter of that transformation. The U.S. housing market isn't crashing, it's being redrawn. Corporate capital is becoming America's largest landlord while families struggle to remain owners. If these trends continue, the American dream of homeownership will increasingly belong to institutions, not individuals. Stay informed on how this and other global shifts reshape economies in everyday life. Subscribe to Global Lens and turn on notifications for weekly analysis that keeps you ahead of the curve.